Okay, good. So then we do what? We balance. So the balancing off is really the normal one. If you remember from our financial accounting balancing of ledgers, you add the sides, see the side which is greater, and then you have a balance carried down, a balance brought forward. The fluctuating capital account, is similar to what we have done up there, but this has a cumulative effect. You bring in the capital itself. It's a combination of the capital account and the current accounts, if I may use that. As you will notice, everything else has remained the same, okay? But we have brought in the what? The capital, 250, 130, and 120, and we are balancing off. We want to see, when you look at your capital account, the money that you invested in, and these other dealings you have made with the partnership, how much do you actually remain with in net effect? I think we will do an illustration in class and then you will appreciate it further. But it's really a combination of this and this, all on what? On one account. That is when you produce the fluctuating capital account. Even when you take a look during your free time, you will notice that it is really more or less the same, just that we are bringing the capital to look at the net amount that you remain with at the end of the period. Illustration number 2, we'll do it in class, since it's a bit detailed, but it's really more or less the same thing. We're better off doing it in class. I will just take you to some explanatory information here, so that once we meet, then we're just dealing with the calculation on Sunday. We can have changes in this partnership structure, okay? And the changes can be, we can admit a new partner, okay? We can have one partner leaving, he can retire or he can even die. And then we can just have an agreement. And we say that, yeah, we have been having a profit sharing ratio of 5 to 3 to 2, but let's change that from 5 to 2 to 3, or maybe from 4 to 4 to 2. So you can change some of those numbers. Dissolution, you can choose to close the partnership, and then you can also change from a partnership to a limited liability company. It's very common because, some people might be a partnership, but because of the legal complexities that come with a partnership, you actually want to change into a limited liability company, because we all know that there are actually some aspects of dealing that a partnership cannot do, and you're required to have a limited liability company. On the same note, we also have those that you can't do as a company, but rather as a partnership. For example, accounting practice and law and legal practice, all those partnerships are always just partnerships, not limited liability companies. So because of the need, you might have to change from being a partnership to limited liability company. So how do you deal with such? When you admit a new partner, the only thing that happens is he just brings in money, period. When you bring him in, he brings in money, so you have new capital, okay, whereby you're going to debit cash because you've gotten money, and then you credit capital. Just like we do even in companies. When you start a business with money, you just debit your bank or cash, and then you credit your capital account. That is the double entry that is going to happen when you admit a new partner. You realize that, of course, something will change on the profit sharing ratios, because now you have an additional what? An additional person. If you've been having 5 to 2 and you're only 2 partners, if you have a third partner, it might be 5 to 2 to 3, and therefore the rate or the ratios within which you're sharing your profits have a little bit varied, because a new person has done what? Has come in. If you have a retirement or death of a partner, when somebody leaves, you're going to have to pay him his money and he goes. Because you're going to pay him, you have cash moving out, therefore you're going to have to credit your what? Your cash account. and then you reduce his capital account because he's actually leaving the what? The business and drawing out his money. That's why we have a double entry of debiting capital account and crediting cash. When these people come in or leave, we might have goodwill. Somebody might be leaving a business, but I hope you all know what goodwill is. Goodwill is like a name. I've been in business. If somebody is going to say, I'm going to sell off Stanbic Bank, Uganda. Stanbic Bank has assets, liabilities, and everything. But besides that, it has a brand. That is, somebody is going to come up with the cost or the value of that brand that he's going to do what? To sell to, and we normally call it goodwill in accounting. So somebody might be leaving the partnership maybe after 3 or 4 or 5 years and is going to say that on top of the money that I have in business, I'm going to charge you guys this much as goodwill, because the day we started this business and today when I'm leaving, it's not having the same value. So these things could arise, revaluations, goodwill, and then they might happen as and when you do it, as and when you make some of these changes in the partnership. So if somebody is going to charge you goodwill, then you're going to have to create a goodwill account, and of course you're going to have to credit capital for the remaining for the partners. So you debit goodwill account because goodwill is like an asset sort of, but we call it an intangible asset. And then you credit capital account for the partners before the one who is leaving. And once the transition happens, we have brought in goodwill into play when Victor is leaving the partnership. Okay, as soon as Victor leaves, because he's the one who is even charging us goodwill on his departure or on his resignation or on his termination, then we need to kill that goodwill account. The moment Victor leaves, the remaining partners should share that goodwill and they keep it in their partnership as what? As a going concern. That is when we start debiting the capital accounts with a new profit sharing ratio, and then we credit the goodwill. The reason as to why we are crediting capital accounts, somebody is selling you something which is worth 100 million, but he's selling it to you at 120. So he's charging you extra money than you are actually seeing. So that extra charge, or that we are calling goodwill, is going to be a cost on the remaining on the remaining partners. And if it is a cost on the remaining partners, it is definitely going to do what? To reduce their capital accounts. Then we can also dissolve a partnership. And when we are dissolving a partnership, basically we are closing down everything. And when you're doing that, you create an account which we call a realization account. And you will start by clearing. If there are any liabilities for a partnership, you settle them. If there is any assets for the partnership, you sell them off. If you go through that step-by-step approach, you realize that you open the realization account, debit with assets. Once you sell the assets, debit cash, credit the realization account. If the any assets going to be taken by the partners, remove the assets and credit the realization account. If there are any creditors you're paying off or that are being taken over by the partners, you just pass the double entries. You really just have to see what is reducing and what is increasing. Because when you're dissolving a partnership, by the mere fact that these are individuals who are working together, sometimes you can even say, we have this data, partner A, take him over. We have this creditor, partner A, take him over. We have these assets, I am going to take them. Maybe they could be shares. I'm going to take them from the partnership. So that is like a sale to one of the partners. So you just have to go into pass those entries, and all of them are going to have to go through a realization account. If you sell and get money, money is going to come through debit cash, credit realization account. If the partner decides to take over some assets, reduce his partner's account and credit the realization account. If the partnership has liabilities and you choose to pay them by bank, pay out cash, credit the cash, and debit the realization account. And whatever remains on the realization account after you have sorted out each and everything that the partnership had is either going to be a loss or gain on dissolution of the what? Of the partnership. We can have instances where the partnership is not able to discharge the liabilities. You sell all the assets, you take over all the liabilities, but you still can't finish them. Then it means that the partners are going to have to do what? To share that deficiency in their profit sharing ratios. Because with a partnership, there is no limitation on the liability. If what is in the partnership is not enough, then you, the partners, have to do what? Have to figure it out. That is by the one of the major risks that is involved with dealing with partnership. Whereas for a limited liability company, the liability is limited to the share capital of the members, but with a partnership, even your house that you sleep in, they can come for it and sell it as long as the money in the partnership is not enough to discharge its what? Its liabilities or its debts. So that is it, step by step, from formation of a partnership up to the time when you close the partnership. So I request you guys to read through in detail. If there are any questions, you can give me a WhatsApp and ask me. On Sunday, we will do one illustration in addition to what we have looked at, and then we should be good to close off this topic. So on Sunday, we'll look at this illustration, one more, and then we will look at accounting for joint ventures. Okay, so thank you very much. I'm going to share this recording on social media. I normally like using YouTube, and then I will share with you guys the link just in case you need to go through it. And for those who haven't attended the class, those will be able to go to YouTube and take a look and acquaint themselves with this module. Do you have any questions for now?
No, I don't have any questions.
Okay. Sarah, do you have any questions from your side?
Victor, me, I'll ask you later, not now.
Okay. All right. Thank you so much, guys, and wish you a very good night. We catch up on Sunday morning.
All right, then.
All right.